Hi, team, hospitality accounting, and we are working on adjustments to the trial balance. This is the second video in the adjustments series. And if you try to watch this one without watching the other video, the intro to adjustment, it's not really going to make a whole lot of sense. So it's really important for you to have watched the original video about the overview of adjustments to a trial balance, because we're going to go into some depth here. So we know that accrual accounting, which is what most businesses use, requires adjusting entries. And so if you think about the cycle of the accounting cycle, we are at the post-adjusting entry stage, which is why we're playing with adjusting entries. Now, let's have a quick look. Adjusting entries, well, they are journal entries that are used to reconcile transactions that straddle across different accounting periods. So an accounting period could be 1 month to another. If we close out the one particular month and start a brand new month in the accounting cycle, we're straddling two different accounting periods. It could be a month. That period could be a quarter, so 3 consecutive months, or it could be that period could be a year. There's different ways to define an accounting period. The point is, adjusting entries are journal entries that are reconciled transactions that straddle different accounting periods. And you could look at it visually like this, right? Where we're closing one period and starting another period, and we need to find a way to bring some harmony or balance between those different periods. And in the previous video, it talked about and gave this example here. So just a quick recap. So here, this situation is we got fire insurance expense, top left-hand corner, it costs us $12,000. And in the middle column, under the cash accounting method, the $12,000 is paid in January, one lump sum paid in January, and fast forward all the way to the end of the month, the total paid for that year is $12,000. It just happened to be paid in one go all the way back in January. The third column, follow the 3 stars, the accrual accounting method, is by the end of the year, we still would have paid $12,000 for the insurance, but in those $1,000 increments, so just popped up in that red box, each of those $1,000 increments needs to be an accounting adjustment made on a monthly basis to take the original payment of $12,000, which would have still occurred in January, and spread it out evenly across each month of the year. So that's the background to these adjusting entries. So let's go and play with it. So adjusting entries, there's some common adjusting entries that fall into some categories. Those categories, follow the stars, prepaid expenses, where we could prepay rent. Like start of the year, we could pay rent for the whole year so we don't have to make any further rent payments throughout the year. But what we would do is make adjusting entries that pick up the monthly equivalent of those rent payments. So prepaid expenses could be prepaid rent or prepaid insurance, like that previous example. Or accrued expenses, like where the bank has been billing us for loan interest, but we haven't yet paid them that loan interest. Or wage expenses, where our employees have been clocking in and they're paid every 2 weeks. So every day up through that 2-week period, we're accruing an expense, but we haven't actually yet paid it. So categories, prepaid expenses and accrued expenses. Some more categories: unearned revenue, where maybe a client pays us up front for some catering service. We haven't yet provided that service. When we later on provide that service, we're going to need to make an adjustment. Or the category of accrued revenue, where we've provided the service, but we haven't yet sent them an invoice and they haven't prepaid us. So they owe us, right? And there's some accrued revenue going on that needs to be adjusted. These are all adjusting categories. And then this last category of depreciation, which is its own big bucket. We're going to dive into that a little bit later on. So just a quick recap, these adjusting entry categories: expenses, revenues, and its own special snowflake, which is going to be which what drops under its own special snowflake here in a second. Expenses and revenues, and something special. Expenses were prepaid expenses or accrued expenses. Revenue category was unearned revenue or accrued revenue. And when we're accruing, we're building something up. And the special snowflake which is depreciation. We're going to circle deeper into that a little later yet. So expenses, we had prepaid expenses and accrued expenses, and we're going to dissect the expenses a little bit as its own initial category here. And depreciation, we're going to dive into. So expenses and depreciation are going to be the two areas that we spend most time exploring when we're playing with adjusting entries. Prepaid expenses require us to post adjusting entries, right? Back to the accounting cycle. So we're going to need to come up with some journal entries that accommodate and reflect and show what's going on with these prepaid expenses. So prepaid expenses, think of it this way. We get a envelope full of money and we prepay an expense. Let's call it January 1. We prepay some expenses, and now instead of a bucket or an envelope of money, we've got an envelope of receipts that show that we made those payments. This analogy of the envelope of money and envelope of receipts, it's going to flow forward, right? So I'm trying to paint a picture here. Prepaid expenses. So in this situation where we had that prepaid fire insurance expense, the cash accounting method would pay it all in January and no further action would be required. So one journal entry in January, nothing else required throughout the year. Under the accrual accounting method, which is what most businesses use because it gets much more exact, then we need to have some journal entries that are going to pick up each of those $1,000 increments. The expense was still paid for $12,000 in January, but it's each of these monthly $1,000 adjustments that needs to come into this new journal entry process, making adjusting entries. So we're talking about prepaid expenses. Here's an example. We're going to rely on our DC Adler, right? DC Adler is still going to be with us. So prepaid expenses are considered an asset. Prepaid expenses are considered an asset in the DC Adler structure. And that's going to help us understand where we place them in the journal entry process. So prepaid expenses are an asset. And since they're an asset, prepaid expenses have a debit balance on the DC Adler grid. Expenses, right? And assets live under the DC Adler grid under the debit side. Let's unpack that all again. Prepaid expenses are an asset. We're talking about expenses and an asset. So we're kind of blurring the lines here a little bit. But prepaid expenses are an asset. Prepaid expenses have a debit balance. And this balance will keep reducing as the asset gets used over the financial year or over an accounting period. Okay, so we're still all operating here on the debit side of the DC Adler grid. That's an important takeaway. We're on the debit side of the DC Adler grid. Assets and expenses both live on the debit side. So we're thinking in terms of money. Money is cash, cash envelopes, collecting receipts, and a bucket of money. We're thinking of a bucket of money that's full and a bucket that is empty. So just trying to create a picture here of envelopes turning into receipts, a bucket of money full that's going to end up being a bucket of money empty. Okay, let's put all this into an example and see what's going on. So here's an example. We're looking at rent. It's a prepaid expense example based on rent. Follow the red rectangle. An independent restaurant owner signs a 5-year lease effective February 1 of 20XX. 20XX means any year. Monthly rent is $2,000. So we sign a lease effective February 1, and every month we owe $2,000 for rent. Follow the red box. The owner pays 12 months of rent in advance on January 31st. So the day before they take possession of the building, of the rent space on February 1, the business owner is paying 12 months of rent in advance. And if the rent is $2,000 a month, $2,000 a month times 12 months means that the business owner is paying $24,000 the day before they take possession of the rent, to give them the keys to be able to get in there. This dollar amount of prepayment, that $24,000, is considered an asset, since the $24,000 is like an envelope of money that's already reserved as a prepayment, right? So look at the picture. So we're $24,000 went out. We got this $24,000. We pay that $24,000 and we get a receipt from the landlord that says you've paid that $24,000. So we've got that receipt, right? That receipt of prepayment is the important piece here. And then we're trying to figure out, well, what would this initial journal entry look like that shows this $24,000 payment of rent? Okay, watch what happens in our journal entry. We've got money going out. We got cash going out. And if cash is going out, we think of the DC Adler, right? The DC Adler worksheet that we built in the journaling process, then cash goes out. So our cash is going to be our credit journal entry. And what we're going to pick up is a prepaid rent. This is going to be a new account. It's going to be a new account that would be featured in the chart of accounts. And it would be a new account that we could flow all the way through from journal entries, using the chart of accounts, into T accounts, and into the general ledger, and into the trial balance, and so on. So prepaid rent is a new account for us that we're working with. Cash here is the credit. We need something to go into the debit column. Prepaid rent is what we're going to debit. So prepaid rent, we're going to consider it like this bucket of money that we've prepaid the money into. Okay, this prepaid rent is an asset. So prepaid rent is an asset. Granted, the money is in the pocket of the landlord, but we're thinking of it like this money that's in a bucket that's being prepaid. And what we need to, like the person adjusting their tie, what we need to do is make some adjusting entries on a monthly basis that takes that prepaid money and moves it out of the bucket. So I'm going to use this image of the tie is going to appear on several slides that shows us an adjustment. So we're looking here at the adjusting process. Okay, still related to prepaid rent. So follow the red rectangle. So adjusting entries that transfer this cost need to be made each month throughout the year. We paid on 31st of January, we paid $24,000 for the whole year. So each month we need to make adjustments. So each month, $2,000 would be deducted from this prepaid rent account, which is an asset in the DC Adler grid, and we need to reposition or reallocate that money to a monthly expense account. This would, right? So we're moving an asset to an expense. Both of these happen to live on the DC Adler debit side of the DC Adler grid. But what we're moving is money from an asset of the prepaid rent into an expense. We're going to expense it on a monthly basis. So this would continue throughout the year, so that by the end of the year, the full $24,000 that originally started in this prepaid rent bucket is now going to show as an expense. Right? At the end of the year, there would be no money left in the prepaid rent asset account because it's all being moved into the expense bucket. Okay, so it looks going to look like this. So here's our prepaid rent asset at the start of the year. And by the end of the year, well, that money is gone. That bucket is empty because the prepaid rent asset bucket would go from full to empty. What's going to happen is the expense bucket is going to fill up over that year's time. So what would these, what would these adjusting journal entries look like starting on March 1? So we're going to look on a monthly basis. What would these adjusting entries look like? So on March 1, our adjusting journal entry is where we're going to credit prepaid rent and we're going to debit rent expense. And in doing this, it's going to allow us to transfer money from the prepaid rent bucket into a rent expense bucket. Okay, let's go back to the original journal entry and we can see these accounts and watch how they're working. So in the original journal entry, this was on the start of the year. So this was on January 31st. We paid, that cash went out. So we credited cash and we debited prepaid rent. This was the original transaction, January 31, when we paid the whole year's worth of rent in advance. Now, on a monthly basis, what we're doing monthly is we're now crediting prepaid rent and we're debiting a new account, which is rent expense. So go back. Prepaid rent here in the original was debited. Watch where prepaid rent goes now on a monthly basis. The prepaid rent goes to the credit line item. So it started as prepaid rent, started originally as a debit. Now prepaid rent on a monthly basis goes to credit. Now what we're doing here visually is we're taking prepaid rent as an asset on the top left-hand corner, and we're transferring that money into rent expense, right? So we're creating this balance and harmony where we're dropping the money into a couple of different buckets along the way. We've got this expense bucket that we're starting to fill up. So prepaid rent, the money is going to transfer through these adjusting entries from the rent asset, prepaid rent asset bucket into this rent expense category. So accrual accounting method requires adjusting entries. What we're doing is we're building and posting these adjusting entries by creating new journal entries that show how we can adjust, transfer, move money between accounts as we expense it throughout a financial period, in this case, throughout a year. So we're building these new journal entries. So the background was that these adjusting entries are new journal entries that are used to reconcile transactions that straddle across different accounting periods. So month to month, we're moving through different accounting periods. There's going to be another video yet that gives you another example, but the value here is, after watching the previous video that gave you the overview of adjusting entries, this video helps showing you with the visual reference of the buckets and the cash envelopes. Cash is moving, money is moving. We're touching different buckets as we adjust and make adjustments throughout different accounting periods. So the goal here is an example of adjusting entries. And there's a lot going on. This is probably going to take a rewatch, maybe twice or three times for you to be able to get the sense of what's going on here. But objective met, exploring and playing with adjusting entries. Video finished.